Operation Epic Fury means new risks for markets, but can traders navigate the fog of war? Trade tensions were driving the market story, but now it's military conflict. Direct strikes between the US, Israel and Iran have shaken the Middle East and rattled investors. Stocks tumbled, oil prices have jumped, and the race is on to price in what happens next. Markets hate uncertainty, and right now it's firmly in charge. Well, Chris Beauchamp is Chief Market Analyst at IG. So, Chris, investors are weighing everything from a quick declaration of victory to a prolonged regional conflict. What are the key escalation risks markets should be watching for?
Well, I think firstly, we've seen a tiny bit of that this morning is attacks on oil and gas facilities. Given the importance of that to both sides, that does offer major risks in terms of another surge in oil prices would hit stock markets, I think, even further. Also, of course, the effective closure of the Straits of Hormuz. Now, you could argue maybe it's already happened by default through insurers requiring ships to pause for the time being, but that is, I suppose, the risk that everyone's watching for. It's kind of the totemic element that's been always mentioned in the same breath as any kind of US-Iran conflict. And for the moment, whilst it's closed, perhaps in effect, it's not sort of official, and that means there's possibilities the resumption of shipping might yet start. So those are the kind of things we're looking for. Obviously, the widening of the conflict as well to include more actors, and the big risk, of course, is that Iran, pushed into a corner, decides to put something particularly unpleasant on the end of a missile, and that does get through, which is, I think, the nightmare scenario that planners are beginning to worry about.
Well, let's talk about oil, and it surged the most in 4 years, but positioning was already heavily skewed bullish before this broke. Could this crowded trade unwind just as quickly, or are we looking at $100 a barrel?
This is the thing, isn't it? We've sort of been expecting, if you look at the oil prices, almost been expecting some kind of conflict for about 3 weeks now, or at least preparing for one. And I think the expectation is that this will rumble on for a while, but as it depends so much on what happens, as we said, with Hormuz, if the straits aren't closed, if shipping resumes, maybe you do see some of this move unwound. I think we're not living in the world of the 1970s anymore, that the US is obviously a much bigger oil producer than it was, and that mitigates the rise to an extent. Oil prices around $70 are kind of saying to the administration at the moment, you can carry on with this action because we are not in panic mode just yet. But with war, once you start it, you are very much in the world of known unknowns, indeed unknown unknowns. And at the moment, there is still the risk that if this does escalate further, then yes, oil prices could push further towards $80 a barrel.
Well, some reaction already. OPEC Plus has agreed to accelerate output increases. Could this conflict force them to open the taps even further?
I expect so, really. The inclination to increase production was already there, I think, to sort of take advantage of the rise in prices, and the temptation to try and crowd US shale gas producers out of the market also kicks in, because I think the more you see oil above $80, the more likely you see US shale gas really coming into play. So they'd like to avoid that happening particularly. So it's kind of, again, you're seeing these checks and balances that always occur with markets, that it's not simply a one-way trade here. And inevitably, the broader supply situation is already quite strong. This merely adds to it. And if we see an earlier than expected resolution, then you might again see a lot of these price moves unwound.
Let's turn to stocks now, and Barclays is warning investors not to rush in and buy the dip, as markets have become conditioned to short-lived geopolitical shocks. But could we be looking at a deeper correction this month?
Well, we haven't had a proper correction, if you like, since April, really. It has been, despite the recent sideways trading in software stocks and US tech, it's been a relatively quiet market despite everything. Sell-offs have been limited. In one sense, we are overdue a sell-off. I think Barclays is right to say that sometimes the knee-jerk reaction isn't the right one. Just because we've become conditioned to such a quiet market doesn't mean it can go on forever. History shows you that geopolitical events do tend to fade in importance very, very quickly, certainly for stock markets. But we have to live through it first, I think. And simply, we are hours into this conflict right now rather than days, and there's still plenty of time to see how this plays out. I think you've got to watch to see how cautious investors have been. As I say, it's the first proper sell-off we've had, and you really find out what people's risk tolerance is in these kind of moments.
Well, risk aversion is rising, though, yet treasuries are selling off rather than rallying. Why aren't we seeing traditional safe haven response?
Well, I think in one sense, people are, because this involves the US, there isn't always the same urge to immediately rush for those treasury havens. I think there's concerns that this is a US administration that obviously has been far more keen to use force to get what it wants in its geopolitical goals. We've had that with Venezuela, Iran now, Cuba is being talked about, and investors have very limited appetite for this kind of foreign policy adventures without any clear end goals. The fact this one is so open-ended, and as with ever with Trump, it's very hard to tell what his aim is with anything, and it changes from day to day. We've already seen that with the reports he's given to newspapers, that people are again opting to maybe stand back from their usual safe haven simply because of the unpredictability of the White House.
That was Chris Beauchamp from IG. Don't forget you can watch more videos on Reuters.com.